Hello, this is Ken Tomko with T2 Asset Management doing our monthly video recording of what's going on in the markets. As always, please don't use these videos for trading purposes. They're for information only and a review of what we're doing. I always start here with the weekly chart of the S&P 500. This gives us the last, going back to 2021 over here. So solid 4 or 5 years. You can see the uptrend that we've had for most of 25. 25 started out with a pretty nasty market decline, but has since gone off to the races, and we're sitting right near all-time highs. Having a little rougher time today, but still, as you can see, if we look at the big picture for the week, we are still up for the week, and it's been all systems go and higher. Put on here the recent kind of near-term support that we would expect the market to hold. That if it goes below there, we might be looking at a near-term decline. But so far, everything in the long term looks pretty good there. Come down here to a daily chart, gives us a little more detail last 2 years, and put up some of our major moving averages here, the 200-day moving average and the 50 and the 21. And you can see the trend line holding up. Certainly, we've had our moments where you get a week or so that's really pretty weak, but overall just keeps holding that trend upwards. And that's all we're still seeing. Nothing yet that's telling you that a big decline is happening. Not that that couldn't always be the case, but just keep it in context that we are still holding this uptrend and could be one of these. As you see here, we get these couple of days of big pullback. Everybody starts getting a little nervous, and the market just corrects itself again. So until we see that change, we're going to say we're still in up and away mode. We come down here to a little more detail. This is a 2-hour chart, and this will give us about the last 6 months trading. And you can just see the overall trend. As I said, the adjustments back and forth, some bigger than others, but still it just is grinding its way higher. Right now, we might be moving towards the bottom of that channel, and it can test that, certainly. But as of right now, this doesn't look any different than any of the other little pullbacks that we've had in there. If we look at some of the what's going on underneath the market, as far as the bullish percent, now this is the percentage of the S&P 500 that's in an uptrend. Right now, that's at 48%. You can just see it's been declining here over the last 4 or 5 months. That normally, if you're sitting up here at all-time highs, which that is right there, the 6920, you should see a lot of stocks participating. The idea that we're only seeing about half of the market participating right now is a little bit of a scary prospect, to be honest. If we look at the advanced decline line right here, chart, that's pretty flat, so that's not really telling us any problems there. And then finally on the bottom, the VIX, the volatility index, and this is the price that people are paying for options contracts that would protect their portfolio. So it's stock insurance, if you will. And you can see right now we're getting a little bit of a spike. It's above 20. Certainly not hitting a runaway number. Let's see if we still have it. No, we don't have that. Normally you'd see 40 or 50 in the VIX when you get a real serious sell-off, but that hasn't happened yet. But right now, the fact that the percentage of the S&P that's in a uptrend is less than half of the S&P, and we're seeing a boost in the VIX. It wouldn't be surprising that if we break down below this trend line here, some of this near-term support, maybe the 6650 level, that things could get more interesting, and then we'd certainly be looking at taking some risk off if that were to happen. Looking at some of our other internal indicators here, look at the ratios between discretionary stocks and staple stocks. Certainly, in bad times, you won't take a vacation, but you'll buy a can of soup. That's kind of this ratio here. And it had been all consumer discretionary all year, except the early part. Obviously, that wasn't happening. But right now, we're seeing a little bit of a sell-off in that, so that's a little heads up there. Same with the tech sector versus utilities. Obviously, the tech sector has been leading this year. A little bit of a decline, but it just could be one of these normal corrections too. Nothing too serious yet. Also, biotech stocks divided by healthcare stocks. We would, in a rising, strong market, we'd expect biotech to outperform healthcare, general healthcare. A little bit of correction maybe underway there. And then finally, hotels versus utilities. We would usually expect hotels to do better than utilities. And well, that's actually been declining most of the year. It's kind of going the other way right now, but I don't know. Underneath all this, that there are definitely some signs to be concerned about. That perhaps as this little sell-off here starts to unfold, if we get below this 65.50 area, it wouldn't be surprising to see it accelerate a little further and a bigger decline start. We go over here to interest rates. I've always been highlighting here, we've been in the same range, this 4% range on the U.S. 10-year Treasury price. Gosh, for just years, 3 years now, it's just been sitting in that range. So nothing too much happening there that's going to trigger the markets. And finally, if we come down here and sort of look at our GDP growth rate, now the prior print had been a negative one, but the most recent one there, okay, 3.8. That's not so bad. That's pretty good. Non-farm payrolls, we had this one here, our last one. This is barely above zero, the most recent read. So that's not a good thing. Inflation hanging out around 3%. And then finally, I like to look at retail sales here. That's barely holding above zero too. So there's a lot of things out there that tell us that we could sort of see a slowdown here in the U.S. economy. None of it's saying that there is one right now, but definitely some things that are weak. So this wouldn't be a place where I'd be adding to risk as much as just sitting back and seeing how this plays out. Finally, we look at valuation, and I've said this in all the prior videos that as we look here, 44.50 would be 20 times earnings on the S&P 500, which is about where we'd somewhere in that range is probably a healthy market. We're way past that, so the market relative to earnings is really overvalued, and you could get a correction at some point. That's a terrible timing indicator. It can stay that way for years. But it's really not a good sign when it's up there, that there is a bit to worry about. All of that being said, and saying there are things underneath the market, I've learned a long time ago to just follow along with what the market's telling you, because it can be irrational. It can do things that you don't expect, and it can do it for a long time. So as long as we remain in these uptrends and it's above key levels that we're looking at, we're going to stay invested. But if it does break down below that, we will be fairly aggressively taking off risk for our clients. So I hope this was helpful and informative. I'm going to put up our contact information if you'd like to hear anything about what we're doing for clients or have questions for future videos. Please don't hesitate to reach out and ask. Otherwise, have a great day, and we'll see you at the next update. Thank you so much.